Scott Hill, welcome back to our show. Patrick, have you two ever met?
I don't think so. No.
Nice to meet you, Patrick. Nice to meet you, bud.
Yeah, right back at you, man.
Yeah, sorry we had some technical difficulties. It's always Vito's fault.
Always
Every
Vito's
time.
fault.
Blame it on
Vito thinks
Marine.
he's very special and fancy schmancy with
Yeah.
his gear and stuff, and
Oh, yeah.
points his nose up at us regular computer users.
I'm surprised he doesn't have like background singers and everything already.
That comes in
post production. There you go.
I'll let you guys talk for a little bit. We're recording right now, but I need to get some more water. Hang on.
And Scott,
yes, sir.
Do I have it right that you used to be in the Army at some point?
That is sacrilegious. No, I was in the
Navy.
I was in the Navy. Yeah.
Just so it's clear, Army did beat Navy on Saturday.
They did. I think the Navy just was feeling bad for Army and what those guys have to go through, those grunts. We throw a bone every once in a while, and that's what we did in 2023. We'll get them next year.
Clearly.
Yeah, right. I was Navy. Now, was it you that you were in the Army, right?
Yeah, I'm still in. I'm a drilling reservist. I think I'm in my. And next March will be my 27th year, I think.
That's awesome. Thank you for your long service.
Oh, right on. Yeah, thank you.
27 years?
Yeah.
Dude, you were just saying you're like 28 years old.
No, I look 28 years old. At least that's how I started looking.
No, I think what I was saying is you look like you aged 28 since you've had kids.
Aged during this broadcast.
That's great. Oh man. I like the narrow frames of the video. It cuts off any holiday extra eatings. Oh, there we go. Okay.
There we go.
There we go.
Good deal.
I can make you the main guy when you're talking now.
Fantastic.
So this is the first time. No, you and I have talked, Scott, you and I have talked on this before, right?
On which specific topic? On this platform? Yes.
Yeah, just chatting about loans and what's going on. And
yes, many times. Yep, we have.
And Scott, so I'm not quite clear on exactly what it is you do. If you could just like.
I put people in debt. I'm a loan officer. I own a mortgage company, and so I help people finance their homes. And that's my joke, is that I put people in debt, but it's the best debt you're ever going to get. Leverages your wealth, changes lives, and enjoy doing it. I've been doing it 26 years now.
Oh, awesome. Is there like I want to say general purpose that came up for you? Do you have a target market or you just help whoever? Like, how does that work for you?
It's home buyers. I'm more in residential lending, right? So I do the gamut as a broker, everything from your conventional loans to your jumbo loans, your government loans. We do reverse mortgages, home equity lines of credit. We pretty much do everything. That's the reason I wanted to get back into brokering, which I've done in the past. Is just so much more flexibility and options for clients. You could be a lot more nimble. But typically it's going to be residential real estate, whether it's primary, second home, investment, do it all. From that standpoint. What about yourself?
I'm a financial advisor. I'm a wealth planner, and awesome. I say again.
I said awesome.
Oh yeah, that's right. See, Vito, why don't you ever respond that way?
Because you're a financial advisor. You're like one step below realtors.
Yeah.
Remember, he's a Marine. Just keep that in mind.
And so I've been doing that for off and on for, I want to say, about 24 years. I say off and on because although I started pretty young, obviously after 9/11, things were busy, so I was gone a lot.
Yeah.
And so I didn't have a long streak of like focused work in this until about 2014.
Right.
13, 14, something like that. Yeah. But however, I mostly work with people who are self-employed or have a small business. And Vito doesn't know this, but actually in 2024, I'm actually going to be getting even, I'm getting very even more targeted. I plan on working, although I'll still work with people who refer me somebody that they like, because I only work with people I like, except Vito, of course. And so if they refer somebody over, it's probably people I would like as well. However, I'm only going to be actively pursuing people who are veteran-owned businesses or veteran self-employed types of folks. So glad to meet another veteran who's doing something I might need some help with. Awesome.
No, that's awesome. I'd love to help you in any way possible. What's really cool is I work with my wife. She's actually been doing it longer than me. Like I said, I was in the Navy for 10 years, so I didn't meet her until I got out. She was 10 years already into the industry. She's a former underwriter and everything. I do the fishing and game planning, if you will, with the clients. But then, gosh, she's so invaluable from paperwork turned into approval all the way to closing so that I can do what I like to do and she can do what she likes to do. And we don't have to cross over. It works out really good. So she's amazing.
And the follow-up with Scott's, it's Lisa, right?
Oh yeah.
Lisa is impeccable at follow-up, pushing things through, making sure every file is completely done. It's always a smooth process. I can't say it was with Scott. It's really with Lisa.
Partnership with his wife too. Like he makes the money. No, you make it. No, you spend it and make it. And she like, what? No. Okay.
No. Yeah. So I initially attract it. She makes sure we don't lose it. That we do a great job all the way through.
I make the money and I get $20 a week. That's
you
it.
make the money and she keeps you from spending it.
That's correct.
You make it, she keeps it. That's the partnership. There we go.
Yeah, she's really good with it, managing it. It works out. I always say the day she says, I'm not doing this business anymore, I'm not doing it anymore. I'm too spoiled with how important it is to have a team member like that. I couldn't find someone to replace her. It's impossible. So I'm blessed.
We have another veteran loan officer that we talked to, and he jumps from business to business. He's a great guy, right? And his Lisa recently left, and in the middle of one of the deals that we were working on, and it just fell apart. And
what do you mean left? I don't get it.
She stopped working for him.
Oh, but it's not his spouse.
No. Yeah.
Oh, gotcha.
No. So technically the title that Lisa does is loan processor. She does all the heavy lifting. Scott's the pretty face, even though Lisa's beautiful. He's the one he's the front man. He's the one that brings in the business, and she does
face for radio only.
Face only a radio can love. Right. Joe Rogan, you're not.
That's right.
Yeah. And then Scott and I met 5 years ago by a friend of ours, mutual acquaintance who's since passed away. And we've done a couple of deals together. And I tell you, every time a deal goes through with these guys, it's smooth like butter. So
thank you.
Just yesterday, I sent you a lead, right?
Was that I think I responded in 15 seconds, set the appointment in 45 seconds, and had the call today at 9:30. And yeah, it's going to be, I gave him a little homework though. He's got to touch base with you, and we got to figure out how to make this work and put a plan together with his price point. But we're not going to give up trying to serve him.
So it's going to be a long haul.
Yeah.
I'm excited that Vito finally introduced me to you. I didn't have a veteran loan officer in my sphere of connection.
I don't have a veteran financial planner, so this is a match made in heaven.
Oh my God. Should we put you guys on mute for a little bit?
You just take yourself off the screen. We don't need you anymore.
I'll be done. Exactly. So the reason why, Scott, we asked you to come on board today is because a couple questions. I keep asking all these crazy hairbone questions, and I'm pretty sure I know where the answers are right now.
Sure.
But the main question I have from your 26 years of experience, 27 years of experience, what happens to the market when rates go down? Because this last week, what happened?
Yeah, it really depends, right? It depends on where prices are. The fact of the matter is what drives the housing market is affordability and how paychecks match up to that affordability, whether it's coming from the interest rates that are causing the payment or the loan size and the interest rate that's causing the payment based on the house price and the ability to put down payment based on the house price. So it's multifaceted. We have a problem right now with affordability, even with rates coming down. We had a problem with affordability even when rates were low to some degree. It's just been exacerbated now. And so I just did an email blast out about rates coming down, and I've had some conversations with clients and they're saying it's still unaffordable right now. And that's not something that's just going to change because of a percentage drop in interest rates. We're down into the mid sixes now, which is phenomenal. We hit 8, 6-7 weeks ago. So we still got an affordability problem. And I think that, especially in the Bay Area, I don't really, and I'd love to get your take on it, but I don't see prices reducing themselves at all. I see a huge problem next year with affordability for borrowers from the standpoint of home prices going up because of lack of inventory, because of the interest that's going to be peaked once those rates do hit down into the low sixes and mid fives. And now we're going to have 4 times, 5 times the amount of buyers desperate to get into this inexpensive market, bidding up the home prices, exacerbating the problem. So it is a problem. Yeah.
So
Kind of your take on it.
what I've been telling people for the last 2 years, that's about when April last year, actually, April 22, when the rate started going up, that slowed down the market just a tad bit, right? Slowed down for about 6 months, 8 months. We saw prices contract because rates went up. Then 7% became the normal versus the 2%. And people started going back into normal buying mode. And I just closed on a deal yesterday, and I just got into contract on another one, a listing that I had. The first one was a listing, original everything, over in Cambrian area, and we listed at 1.2, and we listed, what did we sell it for? 1.36, had 15 offers. Yeah, 136, and we expected 1.3. So we listed at 1.2 aggressively. I could have done 1.1. It doesn't matter. Still, the same thing would have happened. And then yesterday, we had the house on market for 7 days. Let me see if I can find it real quick while I'm talking. It's not a good thing. Anyway, there it is. Let me share this with you. There, look at this house right here. Less than 1,000 square feet, listed at 700. So 3-bedroom, 2-bath. It's a train wreck, right?
It's a 3-bedroom, 2-bath, less than 1,000 square feet.
Less than 1,000 square feet. They converted the garage into an apartment, and they had a sunroom in the back that they converted into a living room that could be used. So it has a little bit extra space, but you can look inside of it, and I can tell you specifically that there's just nothing fancy about it. It needs to be completely not torn down, but everything needs to be redone. The kitchen, the bathrooms, the floors, the paint, the lights, the switches, the doors, the windows. It has wall furnaces. Not that's a bad thing, but I listed at 700,000. We had 13 offers, and we sold. I think it sold for 860. No, 835. We were expecting it to sell for 750. Comps on the low end suggested 750 would have been a strong offer. I got 800. I bumped it up, obviously, but we finalized at 835.
Are you going to have any challenges appraising, you think?
It doesn't matter because I had 13 offers, and the top ones had 0 contingencies and more than 20% down, and as is. And so
I guess I should reword that. Is it going to be worth it?
No.
From an appraiser standpoint, it's worth it from the buyer standpoint because we know what's going to happen to that price of that home next year.
Yeah, but we're talking. Appraiser looks at opinion value of today.
Right.
It's amazing. I was just listening to how you laid out the dilemma going forward, Scott. No matter what interest rates do, up, down, left, or right, and we've talked about it earlier about the whole housing situation in general. I think most people are working under the assumption that they're going to wait because there's some kind of 2008 or 9 thing going to happen again because the economy, this, economy, that, and inflation and rates are high. And at some point, something's going to give, and that's when I'm going to get in. I feel like that's
you're absolutely correct about that. And that's fear, false evidence appearing real. The reason for that, we all know, was loose money, no skin in the game. That all changed. There was massive skin in the game after that. There's massive equity in people's properties now. There's massive interest to hold on to a home that has a 2-3% interest rate right now. At all costs, family members will jump in to help someone save that home. It's not going to happen.
It's just very different. 2008 and 9 was a different thing. It is not, particularly when we talk about home values and property and buying in California, especially. It's just not the same. I don't see a scenario, no matter what happens during the election, no matter what happens to the economy, there's still not enough homes and there's still more buyers. I just don't see anything like that happening. Right.
I heard a statistic a while back about the whole 2% interest rate. Of the 60% of the 33 or 35 million homes in the United States, 80% of them, I'm sorry, 60% of the homes across the United States have a mortgage on it. 40% are paid off. 80% of the homes that 80%, 80% of the homes that have a mortgage on it refinance into the 2 to 3.5% range. So those people will never sell unless they absolutely freaking have to. Divorce, death, what have you.
Which
They'll
happens.
never. So that's basically half of our entire supply. So what we're working on are people that are dying. That's why I'm selling these houses right now, or divorce or relocation, and they just don't want to be a landlord. And so our supply has dwindled to nothing. We have 200 units on the market right now in San Jose.
Yeah.
And the demand is out there. It doesn't matter. We do have houses that are overpriced with unrealistic expectations from the sellers, and the sellers absolutely not touching any offers unless it's what they want. I get it. But for the most part, if you price it right.
I think he's frozen. I'm going to say something too. We're waiting for him to go. Oh, there you are, Vito. We lost you. You're back.
You got to pay your internet bill there.
I was gonna piggyback on something you're talking about, people not leaving their properties unless divorce or death and all that. I've been in some conversations with people that are like, if someone dies in the family, they're gonna do everything they can to hold on to that property just because of the payment. They're gonna turn it into a rental. They're gonna move into it themselves. They're like, we won't see this again. Why would I get rid of this? So with the Fed doing what they did to cause that, there's a lot of people that are very happy, but it's causing a whole nother massive problem that we now have.
It's called second and third order effects, right? And
that's right.
That's what's happening.
That's right.
And yet, I think the other thing to consider here, I'm sure you guys probably talked about it before, is that interest rates are still historically pretty good. I think we can't help but compare it to the last 20 years.
I've got a graph up right now. We hit the peak in October.
You know how to share it?
Sure, let me try. Let me go share. All right. And
share the whole screen.
It's just hard to stomach the race because they've been so low for so long. Most of my adult life, we got to enjoy these incredible low rates. However, if you get beyond that, you widen the lens a bit, and it's still not terrible. It's still pretty good.
Can you see this?
Yeah, I'm jumping
in. Okay. You can see that?
Oh, there you go.
Here's October 1981. Okay. Look at that. Look at the trend down. We have been improving for 40 years. This is why no one wants to let go of what they have right now.
Yeah. I mean, you could put back up an inflation graph and it probably kind of looks similar.
These are all different generations of people enjoying and prospering and realizing it kept getting better and better and better. No way they want to let go now after that.
Yeah. It would be foolhardy for them to do it. I was talking to a guy this morning at Dad's Coffee. Every Friday we get together with a bunch of dads that I know from school, from the kids' schools, and we have coffee. And he's a watch guy. He just loves watches. And he said, I'm never going to sell my watches. It's my legacy for my kids. I have a house. I have all that other, whatever. But this is what people do to bank on the legacy of your name as a person that put their footprint on this earth, right?
This is a total sidebar, but I can't help it. Remember, you seen that movie Pulp Fiction?
Yeah.
Of course.
Christopher Walken.
Yeah.
And this watch.
Oh, that's right.
Up your dad's keister. You want to make sure you got it. Anyways, I digress.
Wait, was that Pulp Fiction?
Yeah.
Or was that the True Romance?
No, it's Pulp Fiction.
Oh, okay.
I just watched
True Romance was an incredible scene with Christopher Walken in that one.
Oh, am I getting confused then? Maybe.
No,
it's he's sitting there facing who's the actor in Easy Rider, famous actor. Not fond of it, the other one.
Oh, he passed.
Yeah, and that scene in there where he's talking about to Christopher Walken about his Italian heritage. A great scene. But anyway, I know we're sidebarring.
That's a great movie too.
Check out True Romance when you get a chance over the holiday.
Yeah,
really good movie. With
it's an awesome movie. That was awesome.
Yeah. Good stuff.
I'm sorry, Vito. Go ahead.
We need to get an uplift with all this inventory talk right now.
No, it's true though. So I have a lot of people that are in and out of the market, right? They're like, oh, I want to buy, I want to buy now. And I'm working with one of my escrow reps, and her husband's, oh, the market's going to crash. I'm like, no, there's not enough there's not enough inventory for the pent up demand.
Yeah.
We have years of pent up demand. Back in 2008, we had pent up inventory because we had a shadow inventory of 30 months of bank owned properties that were going to be taken away from people and sold off on the market.
Yeah.
This,
I don't blame people for feeling that way though, only because they're not educated. If you're not in the industry or specifically understanding these things, how would you know that? How would you know to understand that's the situation? Not only that, you're getting marketed to through social media about how that crash is coming, right? Oh, there's a crash coming. Hell, that's gonna be the time to buy, right?
absolutely. But you should buy now and then save up enough to buy when the crash happens, because
I think it's challenging for most potential homeowners, I think, to truly understand what's the strategy here, because the default is I don't understand, so I'm not going to do anything, but hopefully there's a crash coming.
yeah, that's fear.
Yeah.
And that's going to keep you from buying into your future.
Totally.
And we talked about it before, right? When you buy a house, unless you refinance, which is where Scott makes his money, you buy your house and you get locked into that payment. And if it makes sense to refinance because you can lower it, that's great. But you get economically locked into that payment. It doesn't go up every year like your rent does. You build legacy, you build equity, you build value of your estate. And that's when we can trade off to you, Patrick, because then you can start talking to them about investing in real estate investment trust, hedge funds, condos in Mexico. Yeah, there's so many different options, right? And so Scott, before you came on, we were talking about the hedge fund, the legislature being pushed through.
I read a little bit about that.
Not really. Legislation being presented, but not pushed through. That's for sure.
And there's a really low chance of that happening, but I get it, right? The reality is it's single family homeowners have the majority of the home ownership, but then it's mom and pop. But the hedge funds seem to be the bad guys, which is 3%. That's a lot of people. That's a lot of houses, especially in metropolitan areas. But at the same time, that's where you're going to be able to jump in. And are you seeing people buy condos and townhouses right now?
Yeah, I'm like, I got two guys right now, two separate borrowers that are looking for them. One is a gentleman I was just on the phone with about a half an hour ago. We've been talking for the last week. He was looking for what he thought might be affordable when we ran numbers at about $800K for either a townhome or condo somewhere in the South Bay, but on his single income, and he's making really good money, but he's just over the ratios because he's 28 years old. He's got a big car payment. And we decided that he's not to get what he wants and afford it. Because that's what I always talk about with my clients. Hey, yeah, I can bring in a cosigner for you, but that increases your payment. You still got to make the payment. How are we going to strategize to make that work? Okay, so we talked about him getting a roommate, maybe selling that car and getting a cheaper car. And now we're going to need the mom and dad to cosign, put 10% down and bump up to $1 million to find something that he'll be satisfied with. And we're starting that home search next week, most likely. We got to get mom and dad to get all their paperwork in now and get them pre-approved along with him. So that's what I'm seeing. And it really frustrates me that so many young people that are entering and have good jobs that can't find what they want when we had no problem doing that. It's a changing landscape, and I've never seen more co-signing than I have now, or parents dipping into their retirement or their savings to help their kids qualify. Yeah. Right. And maybe you're seeing that, Patrick, as a financial advisor. Maybe people asking you, hey, how's this going to affect me if I help my child or for my retirement plans? But
that's definitely an increasing trend that's been happening probably, I want to say, last probably 5-10 years as that baby boomer generation has started to get to that place where they can do that for their kids.
Yeah. On the other side, there's no shortage of dual income, each making $250,000, husband and wife working in Silicon Valley. And I find the other trend is lots of income, but haven't accumulated much savings yet.
Yeah.
but are on their way to it. They're waiting for their stocks to invest and lots of other things, and they want to enter in. So that tells me there, I have a lot of metrics that say there is no crash coming, and anyone that thinks that is really getting bad advice. And it's up to all of us as advisors. We're, no matter what field we're in, we're still all financial advisors one way or another, that we've got to educate. And Vito, you got a great platform here to continue doing that. So, well, what I find is, as I'm having some conversations with people right now, they're understanding that whole, okay, I wait till next year, it's going to cost me, home goes up $50,000. It's really a $100,000 cost to me because I didn't ride the equity up and I paid 50,000 more. Oh, by the way, I'm going to now have a higher tax basis on my home because I waited. That's also 6 months to a year of not having forced savings of paying a mortgage down. I'm also not getting a tax deduction, and I can't save as fast anyway. There's all kinds of problems with waiting to buy.
Plus, you're paying 12 months of rent.
And you're paying 12 months of rent. And
you're
so
buying, you're paying to buy, just not your house, right? Somebody else.
So my point is, they have to see it. And when you put it into numbers or put it into a spreadsheet or you put it on a graph, a pie chart or whatever, that's when their eyes open up.
Yeah.
Because they're just getting their quick little TikToks and whatever. But if you show them, hey, let's look at what your payment's going to do if you wait until next year. Let's look at what the lost equity is going to be. Let's look at what you're throwing away in rent. When you show it to them, I think the sense of urgency starts to develop. And it's just that they got to have the right advisor to do that, who's out there looking out for their best interest, and letting them know, I'm not doing this to scare you into me doing a transaction for you. It's the reality of what you're facing, and you need to know that. I want you in the market, and you're going to have a much harder time next year. So please don't let that fear stop you. Let's figure out how to do it.
That's right. That's right. That whole narrative and vocabulary around market crash, or economy crash, all those things. Even if those things happen again, like there's still, the math is clear. There's not enough homes for people who want to buy. So even if something were to happen where, okay, there's less buyers out there because financially something happened to them, the deficit's still high enough to where it's not going to cause some major crash in house price. That's just not going to happen. That's not what the math looks like. It's not 2008 or 9. It's not that anymore.
And that's not to say the economy won't crash or could not crash or might not crash. We just don't see it happening on the one segment of our GDP that we're talking about right now. It could be the automotive market.
That's what I mean.
Breaks down
happen.
We just don't know.
It has happened or is happening. Like,
I'm listening to a TikTok guy right now that sells cars, used cars, and he says that there's a massive inventory of takebacks or repos, right? There's the health industry that's overcharging, and there's people that are completely overwhelmed in credit or debt for healthcare. There's the prescription or pharmaceutical industry that could crash because of some sort of legislation. There's the financial market. There's the military, aerospace, right? That could just completely collapse because we shut ourselves off. We just don't know. But we can't just cut out anything. We're talking about our little slice of the bubble, which is, it has zero inventory. There's zero supply because we've stopped building. If you look at the trends of new builds over the last 60, 70 years, that we're down to about 30% of what we've been doing for the last few decades. The last 20 years have been horrible for new builds. We're building as much as we can, but bureaucracy, cost overruns, and just lack of desire, we're just not building as many homes as we should be for the population.
Yeah, that's right.
Curious, what's your thoughts on, we're obviously our own bubble here. Sorry for the word bubble in this conversation, but we're in our own little sphere, if you will, Silicon Valley. Do you feel, because you've done a lot of research on this, in other areas of the country where appreciation levels aren't very high, where equity isn't quite what it is here due to our appreciations, that there could be a slowing or even maybe a little crash in some areas where they're super dependent on one industry? Do you feel that's something that could happen, even though it most likely isn't going to happen here?
Yeah, it depends on the area, and there's always micro economies or micro industries, like smaller towns, like St. Louis. St. Louis has healthcare and they have financial, but they don't have any other industry. So if that happens to collapse, and that could bring down that train. Take Detroit as the example, right? Detroit is a suffering city because their industry left. And what's their industry? Automotive manufacturing, right? I went to Mexico and went to Indianapolis and all these other places. That place is a dust bowl. If you look at, let's say, Cape Coral, I look at Cape Coral every week, Cape Coral, Florida, Fort Myers, that inventory is growing over 6,000 units compared to our 200 units. But it's cyclical, it's seasonal. And when you look at Cape Coral, the main buyer there, the main demographic there are retiree snowbirds. So the best time to sell your house is when people come down from Indianapolis, when they're all frozen over and they're like, I just want to buy a house here. I'm done living in the snow. And that's why there's a lot of houses for sale. Plus, we also had Hurricane Ian go through last year, and they're settling out their insurance claims. And they're like, I'm done living in Florida because I hate the hurricanes and the $10,000 a year insurance. We talked about that with Taylor the other day.
Yeah.
Is it Taylor? Yeah, Taylor, the insurance guy.
And this whole challenge of not enough homes and too many people needing them, that's a national thing. That is totally not just a California thing. That is nationwide for sure. Yeah. With but some micro places that are doing better with the building compared to others. That is a national problem.
And Florida's Cape Coral is a different world than what we have. When you want to buy a new home here, there's a development. There's a couple 5 or 6 acres, and they develop as many houses as they can on it. They either have one developer or 4 or 5, and they develop the heck out of every acre, every square inch. In Cape Coral, it was developed so that you can pick your property. They put in the infrastructure, the utilities, the sewer, and all that other stuff. And then they sell the lot, and then you can build on it. And they have multiple developers that way. They're also doing the standard traditional, when we say traditional, the California way, where you buy swaths of land. But you're under an HOA then too.
What was surprising to me coming out of COVID was the trend of more people working from home. And I thought that would play out in a way where you had people moving farther and farther away from traditionally most wanted Silicon Valley. They're moving to Colorado, they're moving to Florida, they're moving wherever, right? So you're going to see demand spread to other places. I thought that was going to happen and be more sticky. That has not seemed to be the case. And there's been a big push to get people back into office buildings.
Yep. Because
there's like millions of square feet of office space left empty, right? You're seeing huge problems with commercial space, commercial lending space and commercial property space as a result. I think what was it? The largest company just went under. They rented out like small workspaces to people. Gosh, they're the largest one in the country.
Yeah, I know what you're talking about.
I can't remember the name right now. Anyways, and yet then you just oppose that against what we just talked about these large tech companies building their own communities and owning the homes outright and renting them to their employees. And I thought that would be a trend that would probably alleviate some of the local housing costs, but that has not been something that sustained at all.
And now metropolitan areas are coming back and saying, we're going to start charging you by the mile. There's going to be toll booths or toll charges on every road. So San Jose just put a supposition on, because New York's doing it now, and San Francisco is talking about it. So now San Jose's got to talk about it. But they're saying 10 to 30 cents, depending on what time you drive. They're like surge charging, and they're going to charge you all the miles, even though we get taxed on our property tax for roads, even though we get taxed on gas for roads. Our roads are the worst in the nation, by my opinion, no other fact. And now they want to come back and charge us by the mile to use the road.
They're trying to get ahead of it, right? Because they want to get rid of gas cars eventually.
It's just a money grab is what it is. They have Santa Clara County property tax roll was $600 billion a couple of years ago. $600 billion. Now, a lot of that goes to retirement for our people that serve for 20, 30 years. I get that. But there's a lot of stuff that our 10% sales tax doesn't pay for that should. And we pay the highest gas in the nation. And all these are because we voted in these taxes so that we can have a better lifestyle, and they're being mismanaged and misused. And it's not political. That's just how the government is working. It's how the government is working. It's not the politicians, right? Because that ebbs and flows. It's just a big problem that we're having.
Wild.
I know.
I don't know if I had time to get to it today, but I think Vito, did you mention it that you guys were talking about a veterans benefit that is literally or very rarely heard of or used, or I've never heard of this before.
I know nothing about it. I just saw it on a TikTok because I'm a TikTok addict. I admit it. I go to TikTok anonymous.
Don't let friends use TikTok.
Yeah, sorry, I'm stuck.
Yeah.
So there's a VA loan that's not very well known.
So that was something you know about. I thought that was something Scott wouldn't know about.
No, I asked about it yesterday.
It's a unicorn to me. I've never heard of it. I talked to my wholesale reps. They don't know about it. I can't say it doesn't exist, but I've never heard anyone talk about it. I've never seen anybody do it. I've never seen anybody lend on it. I got firsthand from Vito.
I don't know.
One, it came from Vito. Two, it came from TikTok. So believe what you want. But so this whole thing was, you can have two veterans move in together, agree to buy in together. What the hell's going on with you?
Is it your birthday?
No, it did it the other day, just a couple of minutes ago, with my thumb too.
It's probably I said the word unicorn and the AI and the colors and.
I thought you said all that for post-production. What's going on over there?
Yeah.
So you can get two veterans to get together and not just buy 1 to 4 units, which is the standard VA loan, but you can buy 1 to 8 units, have one commercial unit, and then each veteran move into one of the units. I don't think that's
the other 4, right?
Yeah, each of them technically have 4, but because it's 1 APN, I don't think the VA would allow that. I think it's a unicorn, like you said.
Yeah, it was interesting. Haven't heard of that, but I love though that the down payments have lightened on the units right now. That is helpful for people that you need affordability. Jumping down to 5% down on 4 units, that's huge.
And that's FHA, right?
VA, FA, conventional, even 5% down.
Oh, really?
Yep. Yeah, I believe it was 25%, I think, for 4 units, 15% for 3 or 2. Anyway, it's 5% down even at 4 units. Wow. So think about that from a standpoint of someone buying a home, a primary residence, and then using that other income to help them make that payment.
So they can rent out the rooms, but you have to qualify for it.
You got to qualify. And so so there's always a flip side to everything, right? Okay, now I'm putting less down, so I'm borrowing more, which means my PITI is going to be higher. So how's that going to shake out with the rent and the qualifying income that I'm bringing to the table? We got to work through those numbers, make sure it's going to pencil out.
The flip side too, like FHA still has what is like 860 now, but like the VA, there's no income or there's no purchase limit, no loan limit.
Yeah. So essentially how that works is a lot of people think it's 0 down indefinitely, and it's up to the maximum amount, usually like in the high cost areas, about $1,089,300, which is going to, change next year. But the way it works is once you hit that maximum 0 down, it's a really simple formula. For every $4 you go over in purchase price, the vet puts $1 down. So if they bought a home that was $4 over the limit, they would have a $1 down payment.
Oh, all right. I did not know it worked that way.
Because of the 25% VA guarantee. So you got to put $1 down for every $4 over. So I had a client that bought a $1.8 million home, and they took the difference between what they could get up to 0 down, and then 25% of the overage was the down payment. Awesome. And took advantage of the VA pricing, which rates are typically lower. And if you have a disability rating, you got no funding fee. That's huge.
And the funding fee is a percentage of the loan, right?
Yeah, it's a percentage of the loan. And you would think that if you used it a second time, it'd be the same or cheaper, but they actually increase the funding fee on you the second time around. It gets a little bit more expensive. So
the second time you use your VA loan?
Yeah, it jumps up.
If you have a disability rating, any
0
rating or minimum rating?
0. No, even if you have a 0 disability rating, that used to not be the case years back. You had to have 10% or more. Now it's if you get a 0 rating, which you can get, which is for really minor stuff. Yep. And I had a joke. I'm not gonna go there since this is being recorded for Vito.
I guess you can text it to us later on.
Yeah, but yeah, zero funding fee. And I want to say it's, gosh, I should know it, but top of my head, it's 2.25%, 2.35, something
Wow,
like that.
that's
So
huge.
do the math on $1,000 loan. That's a lot of money.
Yeah. And using a VA loan, your rates,
I'd say
just saw
3/8 to a half lower typically.
so it's competitive, right? It definitely
Wonderful
behooves
loan.
you to use it.
Yeah.
Back in my day when I was buying a house, we were stuck at 178 or 180, and we bought a $225,000 loan, and we just couldn't make that difference. And we didn't have that option to do $1 for every 20, whatever, the 25%.
$1 for every 4 over. Yeah.
Yeah, and we just didn't have that. So we did a 80, 15, 5. You had 5% down, 15% second, an 80% loan. And my second was like 13, 14, 15%. But I didn't care because it was $225,000 for a house. I'm like, let's buy it. But we can't afford it. We can afford it. We'll just eat top ramen for 6 months.
Yeah.
And our values went up, and then we refied.
Just a side note, you made me think about, just from a conversational piece with clients, is that 80, 15, 5. First of all, it avoids PMI. And sometimes PMI, there's nothing wrong with it, but that's another way to avoid the PMI. But I tell clients, listen, who cares what the rate is on that? I go, here's what's cool about having a second. You can attack that second. You could pay that second off. And now you're left with a payment on just a first mortgage as if you had 20% when you bought the home. So you have that to look forward to in the future. Your payment's actually going down where you don't, where you're borrowing 95% one loan and just dropping PMI one day, right?
Are you, and with the PMI, it depends on the loan, right? You have to refinance.
Like, for instance, let's say one of our wholesalers that we'll use often is Rocket. They're phenomenal, by the way, on wholesale. They're terrible on retail. They're priced higher, and you get the headset jockeys from across the nation. Right. Wholesale set up for it's streamlined. It's phenomenal. But the way they do it is their PMI is some of the lowest in the nation. And the way their metric is to eliminate PMI, and it's different for everyone, is, let's say I bought my home, I put 10% down. If in the next 2 years, I can come up with a lump sum of that 10% that I didn't have, and I can send it on the loan, they'll let you remove PMI typically right away. If I don't, I've got to keep their inexpensive PMI for 24 months. Then I'm in the window to go ahead and show an appraisal that says, hey, I'm at that 80% or lower equity mark. I'd like to petition to remove my PMI. So that's how they do it, which is
Can you still write off PMI?
PMI, typically, again, I'm not a tax professional. Wait, I'm in a skinny window here, so I got to do it like this. I can't do it like this. How PMI typically worked was, in the past, as I understood it, from $100,000 gross income to $110,000 gross income, every $1,000 over 100 grand of income, you lose 10% deductibility of PMI, and phases out all the way up to $110,000 of earned income. Then there's no deductibility on PMI. But with that said, check with your tax professional.
Yeah, that's how I understand. Over my head.
Yeah.
Tax.
But yeah, typically PMI is still a deductible thing in many cases based on your income.
Okay.
Yeah.
All right. I have a question for you. Can you lend to corporations, LLCs, trusts, etc.?
Some programs you can do that. Your typical Fannie Mae, Freddie Mac stuff, no. But some non-QM stuff, you can lend to those.
Non-QM. Okay.
Yeah. Typically non-QM. I haven't seen it on any Fannie Mae products and majority of jumbo products, but there are non-QM programs that will absolutely lend to that.
Yeah. Non-qualified mortgage. It's typically for investors. So instead of buying a house, looking at your income and your credit score, you're looking at the value of the potential income of that property. So if you're renting it out and you can make $2,500, that's what you're going to be qualified on.
That's a DSCR loan, debt service coverage ratio, which falls under the umbrella of non-QM. But non-QM, non-qualified mortgage, is also, it can be for a primary residence. Just means you're not falling under the typical ATR ability to repay metrics that need to be met. And so that's what's wonderful about a non-QM, non-qualified mortgage, which means, hey, self-employed person, I know you don't have a lot to show on your tax returns. You make a lot of money. We shouldn't keep you out of the market. There's a loan program for you. Let's average your bank statement deposits for the last 12 months or 24 months. That would be an example of a non-QM loan. Another non-QM loan, exactly what Vito just said, would be a DSCR. Great loan for an investor who doesn't want to show any income, doesn't want to deal with a whole bunch of paperwork. Hey, how does this rent pencil out to my principal, interest, taxes, and insurance? Let's just focus on that and make this loan work on this property. Great.
And those are typically RESPA, right? 1 to 4 units, not 5 and 6.
Go up to, gosh, I want to say even 8 on some of those.
And what's the down payment on those?
Typically, you're putting down, if it's non-owner, gosh, I'd have to see because it's changing right. The landscape's changing right now, but probably minimum 15% or more.
Okay.
I want to say there might be someone aggressive out there to do 10%, but probably not. And you got to have a lot of, you got to have reserves, good credit, and you've got to have some experience sometimes with some of the lower down payment scenarios as an investor, or they're not going to lend to you on that program because they're not even bringing your income into it. They're saying, you're an investor. We're relying only on income coming in. Hopefully that income does come in so you can make your mortgage payment. So a little bit more risk there. And then one other product that's great for primary residents, since we're talking about it, is the no ratio program. Perfect for the person that wants to buy a primary residence, which a lot of these products don't work for because you got to meet the ability to repay. They've tightened it a little bit. It was 20%. I believe they're at 25 now. But let's say you got $1 million in the bank, but you're a teacher and you can't afford this home you want to buy, but your husband who wants to stay home with the baby, talking about an example I had, and have some alone time with the baby and not have to work for a while, hey, they can afford it. Just draw off of that $1 million in the bank in that trust. Well, they can't afford that $1 million home on the teacher's salary. So as long as we've got enough money in the bank, we can go no ratio. As long as we can show 12 to 24 months reserves, depending on the down payment, great way to help a person get into a primary residence and not meet the income qualifying. No job on the application at all.
Oh, wow. And there's no impact on, they don't get penalized by interest rate or like that. It's
that sounds like a ninja.
Oh, we lost your.
Oh, I don't call it a penalty. I call it a golden ticket to get into real estate where you're going to make a lot of money. And in a year, you refinance that property. That's the don't look at the pennies, look for the dollars, right? Mindset. Don't trip over the pennies. So that's that fear you got to get the client over, because their first thing is, oh, rate, just like they're doing now. I'm not going to buy because rates are high. I'm waiting for them to come down. So they don't want to lose $3,000 in extra interest, but they're going to lose $75,000 in home price.
Right.
And that's our job to help them understand the difference. You can refinance that rate, right? I don't want to use that overused statement. We know the marriage and the date and all that. I'm not going to use it because it's so overused, but that's what typically happens, right? Is buy now, save money on the property price, refi your loan next year when everyone's running around like ants trying to overbid on properties. They're gonna spend more money.
So one more question for you, Scott.
Yeah.
Only because we had talked about it earlier.
Yeah.
You reminded me right now. A single or a private investor owns their home. Now they're buying investment single family residences. I believe they can only, there's some kind of rule here where they can only get up to, I want to say it's 10, and then they have to get different kind of financing, right? Could you?
Yeah, 10 was the norm. Like I have a family that has like 23 to 25 properties in their family. And we ran into it. The guy that process right there for certain kinds of loans. Then we found other kind of loans where you can go to 20. Then we had a problem because they went going to 22, 23, and then we were able to go to 25. So it just depends on the lender. But some of these non-QM DSCR lenders, we were at like 25.
Okay.
And
so you can get
you could do it.
Financing up to about 8, 9, 10. Then after that, you may have to look at, you got to look at
something. Yeah. I can't remember the latest for Fannie and Freddie right now. A quick Google search would bring that up, but I think they were at 10. I haven't looked for a while, but I will tell you one thing. I did their first loan with not doing a DSCR and going to Fannie Mae, and I will never do that again. I'll get out of the business before I will ever do a traditional loan for someone that owns that many properties, because you've got to document everything. Every single property, every mortgage statement, every piece of insurance on that property, every HOA. What's the history of payments go for the last? I mean, my poor wife, I thought she was going to quit, and I was going to be a realtor on Vito's team and move over and become an agent.
You'd make a lot of money.
It was so much work. I told them we're only doing DSCR now. It's based on the property you buy, or you got to get another loan officer because we won't do that again. That was a nightmare.
Yeah,
And
sounds like.
they realized it too. They didn't like getting all the paperwork, and it took forever to gather it all up. Imagine being that organized on 25 properties and the analysis that goes into it. It's a disaster.
And it's probably in multiple states. So you have to have tax returns from multiple states. And
yeah, no, most of it's concentrated in Salinas, in the Marina Salinas area down there is where they have it. In Monterey, Salinas. Oh, terrible. Yeah. But great family. Wonderful family. Nightmare, though, to handle that many properties, to do one loan at a time and then have to do it again and again every time.
Yeah.
It's the beauty of DSCR.
You handle commercial?
We do. I don't typically focus in on it nor market for it, but we can do it. Yeah, we have wholesale lenders that we can set our clients up with and do it. Absolutely.
Yeah, I know we're going to talk about where the market's going to go, but we all agree that it's going to go up. Even if the economy collapses, it's only a matter of a few months, right? That's what we saw just this last time. April was the peak and went down in all the way till August, which was like 4 months, 5 months. And it started building back up. And now we're like this last week, I looked at San Jose average sales prices were $17,000 on average away from the 2022 April peak. That was an all-time high. So only $17,000 away from it. And yet we're supposed to be in a recession. And yet, now, not saying that it's not happening in Merced or Marina or St. Louis. I pick on poor St. Louis, but different areas have different numbers. So you have to be very educated on what's going on. When you have 200,
that's still that problem. Not enough homes for too many people. That's still a trend line that's not getting closer. It's getting farther apart, if anything.
You look at every one of the counties, the 10 counties around the Bay Area, and only one is below 90%, which is Napa. And Napa is just hurting. I don't know why. They only had 16 sales last week. The most expensive one is obviously San Mateo and then Santa Clara. And we have by far the most units sold, which is 6,800 units sold. And that's down by 1,900 year to date. We just don't have the inventory for the demand. And you're like, how in the hell? I make X amount of money. How can I afford it? There's places for you to buy, right? You might have to travel a little bit, but homeownership is not out of reach. I can get you into a house in Napa or Contra Costa or Alameda. You're in Alameda, Scott.
My office, Alameda County. Yeah.
And do you guys provide financing for folks buying out of state too, as well, Scott?
I don't. I'm a broker. It's a lot to go through licensing in multiple states. A lot of your big bankers get somebody point of contact that's licensed in all the states and they can do that. I may expand a couple more states, but if I look at the opportunities out of state, it's maybe one or two every quarter that it comes out. It doesn't come up a lot, but Florida is on the radar, Texas for me, but right now just California.
Got it.
Oregon to Tijuana. Those borders.
Yeah, I don't know about Tijuana.
And the reason why I was asking is I think for some folks, maybe it is an affordability problem for them to, and the math is an issue that they can't solve with their current income. Renting is cheaper somehow, but maybe buying, on the flip side of not enough homes means if you're a landlord, it's pretty good, right? You got that's in your favor. Those numbers are in your favor if you're a landlord. So, that doesn't mean maybe you don't buy the house you're living in, but maybe you buy a home somewhere where you can.
That's interesting. You brought that up. I have a client right now that can't afford to live here and is we're looking at a property search in Roseville for a rental property.
Yeah.
So he's going to put 25% down. And in fact, we're going to use a DSCR loan and we're going to buy rental property there, and he'll continue to rent here for a few more years because he's just too unaffordable for him. But he doesn't want to not be able to ride the wave of real estate wealth and growth that he knows is important for his family. So it's a new way. It's funny you brought that up because that is how some people are starting to think is, well, if I can't buy here for myself, I'll buy somewhere else, but I got to buy.
Exactly. it's totally a viable strategy for
Yeah.
a lot of folks probably have not considered as well as they could. And to your point you said earlier, it just means advisors need to advise, right?
Yeah.
Yeah.
And
That's it.
people have to take that plunge, right? Once you start buying into it, then you're like, you completely understand it. And if you're paying rent here and you're still riding that economic lock of a house, then you can buy. And then once you save up, you buy another one, and then you buy another one. It's the same thing with the fourplex. That's why I talked to that lead yesterday. You buy a fourplex, and then a few years later down the road, you buy another one, and then you move into that one, you fix it up or what have you. And then as you go, those rents will always increase, and you're having other people pay down that mortgage.
That's right.
And then next thing, after 10, 15 years, you have 4 or 5, and your payoff speeds up because you can pay off your first purchase in 15 years because you're taking all the spare equity out of those, or the spare income, and you're putting it towards that house. There's tax reasons and all sorts of different things to do that. But I know a lot of people that are set up that way, and they don't have to worry about anything.
Yeah.
But we need to build more fourplexes.
Yeah. What are the stats on those right now for availability? Probably pretty low, right?
Few and far between.
Yeah.
And you can get into it pretty easily, but I can tell you that there's a lot of slumlords that are out there.
Yeah.
So they're willing to just sell it as is, and that's it. But then if you're working with a VA, there's certain habitability issues that need to be repaired before you can make a move.
Yeah.
I'm looking at Santa Cruz. My daughter is a junior in high school, and she wants to go to Santa Cruz University. So as we were talking, I was just looking. There's only one fourplex available in Santa Cruz.
Jeez.
It's $2.5 million.
Oh, there you go. That's not. I got that in your back pocket there, Vito. It's no problem.
But the rents are over $3,000 each. So I can tell you that it's probably close to $14,000 a month. That would pretty much pay for half of that, right?
Yeah. So if she's going to move into it, you're going to get 3 units income, so not the 4. But what's that property going to be worth in 15 years?
Yeah.
And you're paying it down.
Yeah.
You know, it's interesting times, but where there's a will, there's a way. And we got to help our clients understand the solutions on how to own and get into the market somehow, one way or the other. But any kind of massive drop in prices isn't going to happen. So we got to find other solutions to make.
That's right. Well, that means you're buying one to live in yourself, or you are, like we talked about earlier, you're buying a rental property, whether it's here in California, preferably, because California's a great place to own real estate, or out of state, wherever it is, whatever it takes.
I'll bet you one of the next trends is people going in together on buying rental property.
Oh, yeah, absolutely.
They can't do it on their own because it's a way to at least get in. Hey, let's get in and do this together. It feels safer. And then we'll split off after we get a hang of this and sell and buy on our own or whatever. But it's a great way to start and get in because you can do that, you know?
Yeah.
I can tell you from experience that we did that in Tahoe. We bought a cabin up in Tahoe with another couple, but I made a mistake. We didn't have an exit strategy.
Mm-hmm.
We didn't understand the nuts and bolts. Who's going to pay what? How much? What is that going to look like? Mm-hmm. And we said we'd buy it and own it for 5 years and maintain it. And we put a lot of money into it. And then at the end of the day, we had this equity that we had, and we're like, how are we going to split it out? We're going to refinance, take us off the market. And there was a lot of squabbling about who's paying what. So if you do that, it's very smart, but have a lawyer draw something up. Sit down with your partner, because they're a partner now, and say, this is what we want to do. What are some negatives? And they're just basically a third party, unbiased expert on how to deal with things like that, how to get out of it, who's responsible for what happens if I get laid off and I can't make my payments, what if, right? So it might cost a couple $1,000s, but it's a couple $1,000s worse not having that grief when you're exiting that partnership.
Absolutely.
Yeah, totally worth it. Another term I used to hear growing up in Spanish, it's cuentas claras, amistades largas. So in English, it's clear accounting between friends. It means leads to long-term relationships, right? Be careful who you do things with, for sure. And that is totally way to do it.
It was making me think, if I was to do that right now, what's one of the ways to hold us accountable? And just what popped into my mind is, after it gets written out, I would have the details of that on an automated email that just pops up in both our accounts every 3 months. It says 4 years, 9 months left. Here's the agreement.
Yeah,
4
don't
years,
forget, because your
6
mind
months
does
left.
wander, right?
Here's the agreement.
Right.
4 years, 3 months left. Here's the agreement. Let technology hold everyone accountable. Set it and forget it.
And you still got to have the right person, because the wrong person will be like, okay, I have 4 years and 6 months to figure out a way to.
Yeah.
I have 4 years and 3 months to figure out a way to.
Yeah.
That was one of the rubs. It was like, we set clear goals saying 5 years. We held on to it for 5 years. And we did the VRBO thing. It was pre-Airbnb. So we rented it out. And then we had this one client that rented it out the entire ski season. We never got to use it. So for 3 years, yeah, he paid for the entire mortgage for the entire year. That was great. But I wanted to go skiing. So defeated the purpose.
Yeah.
There's certain things to think about. And I think, so the reason why we're having supply issues is not just the hedge funds that we talked about the hour before, but also the 2.5%, the very low rates, but also people are investing into Airbnb. And also there's people that are just dying, that choosing to die in their property. Right?
One more. People that can't afford to sell their property and buy another one. They piggied off the low rate one, but
you could do that in different states. But here we have that Proposition 19 that allows you to do that.
Very
so
helpful,
you can sell it and move it out. But in other states, it's not a possibility. So it's, absolutely. So all that pushes into the fact that it's really hard to sell a property when you're not ready. So my business is really the passing of my friends' parents, my contacts' parents. I do divorce, I do trust, I do like relocation, but I don't work with a lot of buyers relocating in, because there's not a lot. And then when they see sticker shock of how much it costs to live here, they're like, I'm just going to move back to New Hampshire. Forget this place. And that's just part of life, right?
Yeah.
But yeah, absolutely. It's just, I think we're going to see our supply dwindle even further the next 2-3 years, until we start pushing builders to develop more property, because the problems that we have, the hedge funds owning the Airbnb could topple. You never know, because they're getting greedy. I have a couple videos on that. And then the people that are buying property, that's not going to go away. The people that have 2% houses, they're never going to get rid of those houses. They can't. I mean, it's foolhardy for them to do that. Even if it's assumable, it's foolhardy to do that.
My only pushback on that is that California in general is full of people who have been conditioned to refinance every so often because they find themselves in additional consumer debt. And their home has been the way to take care of that, which has been made way easier because, hey, the way the rates have been working. I'll be curious to see what happens 3 or 4 years from now. Even sooner than that, I think I already read an article the other day that said the levels of credit card debt that people are now having is starting to shoot way up again. I'll be interested to see even those folks who took advantage and got those rates, as their spending habits has not changed, as their lifestyle habits have not changed, and that consumer debt creeps up again. Yeah, whether they'll be forced to make some of those choices because the 6 or 7 or 8% on their home is still better than the accumulated credit card debt or whatnot, if that makes sense.
Yeah,
so we'll see.
It's true. You're absolutely correct. The credit card debt is at all-time high, and they're going to look at how do I stop from drowning? Yeah. Okay, I'll take a little higher rate on my mortgage, but my overall cash flow just improved by $1,000. Of course, that makes sense. And I'm writing it off on my mortgage.
That's still a thing.
Yeah. So come down again at some point, and I'll take advantage of that. And then you, being a financial advisor, would think like I do. It's okay. You're 3 years into this mortgage. Let's not put you on a 27-year mortgage now. I don't want you to fall behind and front load that interest. I want you to keep going on the track you're on.
Right.
Valuable advice we can give, but you're right, Patrick. People will get rid of those rates for that. They won't necessarily sell, which is the inventory problem.
That's a good point. Yeah, they'll refine, but they won't sell for that. That's for sure.
Those are people that are out there that, like, I can brag a little bit. I go to the gym every day, and there's other people that go, I should go to the gym. I should live a more disciplined life. I don't eat better, but I should eat better. There's certain things that you habitually do, and it takes a conscious choice to live under your means and become more responsible. However, the inflation that we've all witnessed over the last couple of years has made it really difficult for people to live because wages have not kept up with inflation. So you're in a quandary, and I understand a majority of Americans are going to continue to do that, but we're not looking for those people. We're looking for people that want to get out of that situation, that want to be disciplined and do it every day and get up at 5 o'clock every morning, whether you want to or not, and just show up at the gym, because that's how you get to financial security, right?
Little steps every day, right? Little incremental steps, consistency.
I put in but I show up.
You show up.
Yeah.
We know, Vito. We know.
Me in my belly. Get in my belly.
You ever just on the cycle, Vito, just your legs are just going like this and you're working on your phone, but
TikToking on my phone this morning? Yeah. Barely breaking a sweat. Just looking, got my earphones on. I'm like, yeah, this is awesome. TikTok. Yeah. So yeah, it's good to talk. And I think I'd like to check in with you in another month just to see what's going on. If there's anything groundbreaking on the legislature, we should absolutely do another talk like this.
It'll be interesting to see also next year is the Federal Reserve paused interest rate hike, right? And then market immediately responded. So ridiculous. None of it's based on actual performance of a company. Good, but we'll see if they actually drop interest rates next year. It's just
they're talking about potentially three drops next year, right? 3/4 drops.
All of it's so speculative at this point, but we'll see. But whenever it's time for that to make that decision and they announce, it'll be interesting to see what happens and how housing will respond to all that.
Yeah.
But at the end of the day, like we already talked about, there's still this problem of not enough homes and more people.
That's not going away. You're right.
Not going away. So interest rate may go down. That's great, but pricing will still. Well, I don't see how prices will go down, but at least your monthly cost to service that debt will be lower. So,
yeah. All right, Scott, I have a great scenario. You don't have to answer this right now. What if I bought a house over in Palo Alto
at 4:20 p.m.? I have to be at Best Buy to pick up a laptop that I had to replace the one that broke.
This is a good seat. This is a good. Actually, I have to buy a laptop for my son who's in Chico right now. Positing this idea, I want to use the VA loan to buy a property in Palo Alto. $1 million, $2 million, $3 million. A third acre is what I'm looking for. I don't care about the house. It could be a piece of crap ready to burn down. Get my brothers over in New York to burn it down. No questions asked.
By the way, that's a Navy story. I had a guy drive his truck that he couldn't afford anymore, didn't want, drove it down to Tijuana and drove it down somewhere and knock on his door a week later. The police found it thinking he was going to be so excited that, hey, we found your truck, man. He was so pissed off. He was already working on the insurance paperwork. He wanted a different vehicle.
Yeah.
Typical military guy, right? Thinking he's found a way to get rid of the truck. And down in Mexico found it, brought it back to his house. Anyway, sorry, I digress. But maybe
exactly. It's the same, not the unethical, illegal stuff, but tear it down and then put like a McMansion on there, like a 10,000, 12,000 square foot house that I could sell for $20 million. Is that possible with the VA loan?
So there is, I have not done any VA construction stuff, but you're talking about a possibility because there is construction with VA. I haven't done any. What those guidelines are and how much equity you have to be and have in that property and all that would have to be figured out. But I think you probably could do it. The benefit of the VA, of course, is going to be cheaper pricing, right?
Yeah.
A better overall loan. I just don't know all the criteria on it, but I wouldn't tell them that you were buying it to burn it down. I would keep that silent.
That burn it down.
Just to be clear, Vito,
it's a government loan and everything.
Once you build that mansion, you will be disliked by
Yeah.
every neighbor on your street.
Not in Palo Alto. That's where that's where all the
Oh,
money
oh,
is, right?
oh, yes.
You might bring the values up even more. They might help you build it.
Yeah, they might like help me plan. So
Give advice.
I was just throwing that idea out there. I'm like, I'm like, what if I could do that? How much would it cost me? Do I have to make monthly payments? Because I don't want to make monthly payments. And how do I make this thing a thing? And I mean, how much money what am I going to have to come up with all in?
I'm like
Because
the crotchety old neighbor then, I guess, when the dude next door knocks down his house and builds this big mansion, I'll be like, you mother lover.
you can move anytime you want, right? That's the glory of the United States. We're a capitalist society.
That's what BlackRock would say, wouldn't they?
That's right. Patrick, you look like you could have been in an episode of Ozark, man. Can you see him in Ozark at that McMansion down there in Mexico? Right.
That's right.
With the was it St. Bernard's or Dobermans, and you got that look, man.
Would he be a henchman or would he be like an assassin?
I know. What do you mean exactly?
Would he be like
drug dealer look or
He'd be the guy that's trying to break out. He wants to turn his life around, and he's just trying to figure out the right way to do it because he's a made man. And once you're in, right, it's hard to get out.
I thought you said you're like, I'm looking at you, man. You just look like somebody needs to turn their life around. You just look like you got that look.
I'm just trying to
put army
on it. So I'm not saying you're just an assassin at taking on that role.
Right on. I'll take
but
it.
I can see you in there being in that show, man. You got that look, man. I like it.
Right on.
You know what happens to those guys that want to break out, right? They get whacked.
Yeah, that's why
the Italian.
Yeah.
Hey Scott, you better go to Best Buy and pick up that computer.
Yeah, that laptop that they sell you all the extra memory you now need. And this, you know what I'll do before I go? Don't
buy the extended warranty.
Don't you just hate buying a new computer though? First of all, they have to get all the bloatware off. I have them do that, but then they got a new iOS. Nothing works the way you got used to it. It takes time to acclimate. I know there's worse things in life, but I am dreading that part of it this weekend, trying to figure out how to get everything working again on the laptop so that I can use it functionally next week. But anyway,
just do it slowly. I gave my son my 2016 MacBook.
Yeah.
And within 6 months it was destroyed because he's a boy.
Yeah.
It was the monitor cable for the laptop where it goes like this right there at that little hinge. There's a ribbon cable that goes from to the monitor. This particular kind of MacBook can't just replace the freaking ribbon, which would be like $100. No, you have to replace the entire screen, $575 for 2016 computer. So
there you go.
That on top of the labor, on top of what, $700. I might as well buy him a little MacBook Air. Have it brand new.
Absolutely. This was a pleasure. I got a lot out of it. Hope we all did, and I hope our audience did. And I enjoyed it. Thank you for having me on.
Absolutely.
Yeah, Scott, great meeting you, man. I'm hoping I'll reach out to you here.
Yeah, we'll reach out. I'd like to get together, grab lunch, minus Vito. That'd be fun. And no, Vito could be there.
Probably not.
He'll have some marine humor he can pepper in here and there.
So we're all going to get together here next year. There's a whole slot of different classes that we're doing at San Jose State. And Scott, you got invited into this, right? Have you talked to Kimberly yet?
Not that I'm aware of.
Yeah.
Maybe I need another invite. Send it out.
We're like Bob Davis. I don't know if you met him, but he's working on the alumni network now. And we're doing this idea of financial intelligence for the veterans, but now it's being expanded out to the alumni network.
That's awesome.
So we're supporting that, and we're also going to go to students and faculty next.
Let's be champions of education. That's how people get helped. We've got to give them the knowledge. We've got to, and it's so easy to do. And so I love that idea of doing that. I think that's great.
That's why we do this every week. We talk to experts like you to come in, and we're not pitching anything, right? We're just talking about ideas and different scenarios and different things and trying to get people intelligent, because we're not taught that in school. We're not taught that in home. We're not taught that, period. Yeah. And what have I got to lose? If you call me, great. If not, you're going to call your Aunt Betty who sells real estate. I get that. I understand that, but at least we've done our part. And that's what this whole thing's about.
Love it. Love the concept. Awesome.
Yep.
All right, Scott. Let's
get to it. I appreciate you guys.
All right, man.
Reminds me of so many of the military comedy shows from the 70s right there, man.
Benny Hill.
Yeah.
All right, get
That's
out
a
of
whole
here.
other topic. I used to stay up late to catch any glimpses of Benny Hill I could, man. That show.
Heck yeah.
All the little bikinis and
day.
stuff. Heck yeah. Formative years. Sayonara.